Something just happened in the silver market that almost nobody is talking about. And if you hold silver, if you're thinking about buying silver, or if you've been watching this market for years waiting for the right moment, what I'm about to show you could be the most important thing you hear all week. Silver just broke below $60 an ounce. That might not sound dramatic at first, but here's what makes this moment different from any other pullback we've seen in the past 12 months. This isn't a random dip. This is a breakdown through a level that held the entire market together for 6 straight months. And when a level like that cracks, history tells us what usually comes next, and it is not what most investors expect. So before you make any decision about your silver position, stay with me, because by the end of this video, you're going to understand exactly what just happened, why it happened, what the institutions are actually doing behind the scenes, and where this market is almost certainly headed from here. If you haven't subscribed to Gold and Silver Intelligence yet, hit that subscribe button right now. What we cover on this channel is exactly what you need in moments like this one. Let's go back to January 29th, 2026. That was the day silver did something it had never done in its entire history. It hit $121.62 per ounce, an all-time record. And the narrative was simple. Silver had broken out of a 40-year ceiling. Industrial demand was exploding from solar panels and AI data centers. Mine supply was falling, and institutions were piling in. It felt unstoppable. But here's the detail most people missed at the time. At that exact moment, when silver was printing all-time highs, the CME Group, the world's largest commodity futures exchange, quietly raised margin requirements on silver futures contracts. That is not a coincidence, that is a mechanism. When margins go up, leveraged traders have to either post more collateral or close their positions. And when enough of them close at the same time, you get a cascade. Silver dropped 42% from that January peak. 42%. And this is where the story gets very interesting, because that collapse didn't crush the bullish case for silver. It actually created something more important. It created a floor, a genuine zone where buyers kept stepping in, over and over. The $60 level, the $63 level. These became support zones backed by real buying, not speculation, not momentum chasers, actual investors who understood the underlying fundamentals and wanted in at a better price. Which is exactly why what just happened this week is such a big deal. On June 24, 2026, silver opened below $60 per ounce for the first time since December 9, 2025. 6 months of support, gone, in a single session. And right now the market is asking one question that nobody has a clean answer to yet. Is this a shakeout? Or is this the beginning of something much bigger to the downside? Now before you panic, or before you get excited, you need to understand what forces actually caused this break. Because when you understand the cause, the path forward becomes a lot clearer. Here is what hit silver simultaneously. First, the US dollar strengthened, and the relationship between the dollar and silver is almost mechanical. When the dollar goes up, silver priced in dollars gets more expensive for buyers in Europe, China, India, and everywhere else. Demand softens, prices fall. Every single point the dollar index rises puts roughly 1 to 2% of downward pressure on silver prices. That alone was enough to shake the market. Second, rate cut expectations changed. The Federal Reserve signaled it is not planning cuts anytime soon. And silver, like gold, is a non-yielding asset. When rates stay high, the opportunity cost of holding silver goes up. Why hold an ounce of silver when you can earn 5% in a treasury? That logic, real or perceived, pushes investors out of metals and into yield-bearing instruments. Third, and this is the one most analysts are glossing over, solar panel manufacturers reduced their silver consumption by 19% in 2026. Not because demand for solar panels fell, because manufacturers found ways to use less silver per panel. That shift quietly removed millions of ounces of demand from the market, and when the market finally processed that data, it reassessed how tight the supply-demand picture actually is. But here's where things get interesting. Because none of these three factors actually change the long-term structural story for silver. And the people who understand that distinction are the ones who will be positioned correctly for what happens next. Think about this. Despite the reduction in solar demand, the silver market is still forecast to run a deficit of 46.3 million ounces in 2026. That is the 6th consecutive annual deficit. Not the first, not the second, the 6th. Global silver mine supply is contracting, new discoveries are rare, permitting takes years, and above-ground inventories have been drawn down for half a decade. That physical reality does not disappear because price drops 60% from the top. And here is where the data gets uncomfortable for the bears. ING, one of the most respected commodity research desks in the world, lowered its silver price forecast for the second half of 2026. They now see silver at $68 in the third quarter and $74 in the fourth quarter. That is a downward revision. But notice what those numbers actually say. They are still significantly above where silver is trading right now. Even the most cautious institutional voice in the room is not calling for a collapse. They are calling for a recovery. BMO Capital Markets also revised lower, but again, the revised target for the third quarter is $69 per ounce, which means the very banks that are cutting their forecasts are still projecting that silver is worth 20 to 30% more than it is right now. So what do they see that the price action isn't reflecting? The answer is timing. And this is the part that most retail investors never understand until it is too late. Markets do not move in straight lines. Even in the most powerful bull runs in history, the sharpest, most violent corrections came right in the middle. Silver in 2011 ran from $18 to $49 and then collapsed 34% in a single week before ultimately continuing higher. The investors who held through that sell-off made extraordinary returns. The investors who sold into the panic locked in losses and watched the recovery from the sidelines. Now, is this 2011 or is this something different? That question matters enormously, and the answer is hidden in a data point that almost nobody in financial media is talking about. The gold to silver ratio. Right now it takes approximately 61 ounces of silver to buy 1 ounce of gold. The 50-year historical average is between 65 and 70. But here is the critical piece. During active precious metals bull markets, this ratio typically compresses toward 40 to 50 as silver outperforms gold. With gold trading near $4,300 per ounce, a ratio of 55 to 1, which has been reached multiple times in prior bull cycles, implies silver at roughly $78 to $79. A ratio of 50 to 1 implies silver above $85. The ratio is a valuation gauge, and right now it is telling you that silver is cheap relative to gold. Not somewhat cheap, significantly cheap. By historical standards of every major precious metals bull cycle we have data on. And there is one more layer to this story that I want you to hear, because this is where the situation becomes much bigger than just a price chart. The physical silver market and the paper silver market are two very different things. COMEX silver futures, the contracts that set the spot price most retail investors see, can be settled in cash. They don't require physical delivery in most cases. This creates a situation where paper claims on silver can vastly exceed the physical metal that actually exists. And when that gap gets exposed, the price can move violently in either direction very quickly. LBMA vault data and COMEX registered inventory levels have been steadily declining for 6 years. 6 years of consecutive drawdowns in above-ground silver supply. The physical inventory being held in these warehouses is at multi-year lows. When delivery stress shows up in the form of lease rate spikes or vault warrant cancellations, that is when the paper price and the physical reality have to reconcile. And that reconciliation historically comes with extreme upside price velocity. We are not there yet, but the conditions that precede that kind of event are building. So let's bring this all together, because here is the picture you need to have in your head right now. Silver broke below $60. That is real. It is significant. The short-term bearish trend is in place and the dominant selling pressure has not fully exhausted. If the $60 level does not hold on a closing basis, the next major technical support sits between $52 and $55. That is the downside scenario and you need to have it on your radar. But the structural story, 6 consecutive supply deficits, falling mine output, record low physical inventories, a gold to silver ratio signaling historic undervaluation, and institutional forecasts still targeting $68 to $74 or higher by year end. That story has not changed. Not one fundamental pillar of it has moved. And here is the thought I want to leave you with, because this is the question that divides average investors from the ones who actually build wealth through commodity cycles. Every major silver move in history, 1979, 2011, 2020, was preceded by a period of brutal, confidence-destroying selling that caused most retail investors to abandon their positions right before the turn. The shakeout is not a failure of the thesis. The shakeout is often how the thesis becomes true. Because weak hands sell to strong hands, and strong hands hold until the fundamentals are finally reflected in the price. The question is not whether silver is going to recover. The question is whether you will still be holding when it does. If you found this breakdown valuable, please like this video. It genuinely helps this channel reach more people who need this kind of analysis right now. If you are not subscribed to Gold and Silver Intelligence, now is the time, because the next few weeks in this market are going to move fast and you don't want to miss what's coming. And if you know someone watching their silver position right now, wondering what to do, share this video with them. The analysis we do here is built on data, not emotion, and that is exactly what investors need in moments like this one. Drop your thoughts in the comments below. Where do you think silver goes from here, and are you buying this dip, holding, or stepping aside? I read every single comment. Let's talk about it.